now you should hear me, right? 1, 2, 3. Elemento P. Hello, buongiorno. ¿Cómo stai? 1, 2, 3. Hello. I know there's a little bit of a delay. Okay, you can hear me. Okay, great. All right, so let's start over. Equal weighted S&P up against the resistance, pulling back, and the um, pulling back, rising wedge. This can either start to fall apart here, all right, sharp move down, or it will go into something like this. Okay, it will high base. So we don't know which one it's going to be, but it's going to be one of them if this starts to break down. Keyword if. Dividend weighted S&P is the same. Transportation, it's still holding up, but it's on the bottom. VIX it broke out for the second time, hasn't followed through yet. Okay, you could get just another lower high. It's possible. New York Stock Exchange pulling back, same. Dow Jones kind of holding up better than most. Okay, it did break initially, but has continued on up for now. Let's see what this does. S&P 500 has really pulled back, and it's right at that 63-day moving average. 63 days because it takes about a quarter uh, for fund managers to put their positions on. So I want to know what's going on in the quarter, and again, the quarter is 63 days. All right, so it's coming right up to support. The same thing, more or less, for the Nasdaq. Okay, it's actually broken through the the 63-day moving average, not by a lot, but it has broken down. Now, if you go back in time, you'll see that every time it broke the 63-day moving average, that on the reverse back up, as soon as it crosses, it goes to new all-time highs. So just kind of keep that in mind, okay? Now, what we typically want to see if you're a bear, what you want to see is that this doesn't go sharp. It kind of does something like this and then starts to fall apart, all right? So we want to see a move up. We just want a lower high, right? Doesn't matter how much it pops. That's okay if it pops, as long as it creates a lower high and then starts going back down. And that is a process. It takes time. It's not going to happen today, tomorrow, next week, or so forth. Now, if we get some kind of a Eiffel Tower kind of formation, then this thing is just going to start to, collapse. But uh, that's a rare structure. Okay, so we'll go with the more likely. It is holding above the previous high, which was set back in September. All right, small caps broke out, fell apart, had another false breakout right here in that little bull flag and failed. That's not good. That's not good. Um, you break the top, you're going to break the bottom, right? But I don't like that at all. That little bullish structure should have continued higher. Now, in this case, we could say that there is a lower high, right? You can see it here. So we'll see how this works out. But remember, this has been leading as of late, and risk on, FOMO. There's nothing else left to buy, so let's go buy small caps with a PE of 1 gazillion. So we'll see if this starts to go. The rest of the market is going down with it. IPO. Remember this one? I posted this a while back. Let me see if I can find it. And I said, look, be careful with this. This is not a good structure. Where is it? Just give me 1 second here. All right, there it is. Okay. So this was the post back on February 21st, and I said, be careful, and boom, there it is. Okay, so this broke down, um, and kind of popped and then started to break down again. So that's not a good sign. Okay, not a good sign. Just give me 1 second. Let me see who's messaging me so adamantly. Welcome back to this. It's just a friend of mine. All right, so let's continue here. All right, ARC. ARC was holding up really nicely, and then just boom, fucking collapsed right through. IPO kind of led ARC, and then ARC just one more morning you woke up and it's broken the structure below the 63-day moving average, and this is not, this is not a good sign. It did it once back here in October of 2020. Once or twice and then kind of popped. Okay, so if this were to pop up again above the 63-day moving average, then you can say, okay, this is likely going to be a sideways move, but we're not there yet. Okay, we're not there yet. Why do I say a sideways move? Because it doesn't necessarily have to continue to go to new all-time highs. It's more likely it'll go sideways if it crosses above the 63-day moving average. The fangs, remember I was bitching about this little formation that it wasn't following through. Sure enough, it didn't. And now this is no longer gray. Okay, this is a valid structure. And it's a rising wedge. And it broke back into structure. Again, holding that 63-day moving average. Okay, right at it. Let me fix this so I can have reference to it. Okay. Um, get rid of this. Okay. So, if the market leaders are not going to lead, and the small caps are not going to lead, then who's going to lead? IPO is not leading. ARC is not leading. So you're seeing a whole bunch of charts that are starting to break down. All right. Europe broke down again, right up against this resistance area, which is these two highs. One set back in 2014. The other one was set back in 2018. Okay. So keep an eye on that. UK broke down, lower high, not looking good. Germany, okay, broke the previous high and is below it now, or at it, just at it. Okay, so, you know, everything looks broken, to be honest. We're having difficulties trying to follow through. Denmark going sideways. This is what I mean. See this? This is a sideways, but it does have a lower high. And lower highs, M patterns at tops are reversal patterns. Okay, so look for this one to continue lower if it starts to break down. Okay, it's gotta cross the previous low and continue on down. Otherwise, it's just gonna go sideways and then it'll start going back up again. World Stock Market Index is still holding up. That's okay for now. XUS is right at support. Airlines. Okay, airlines had a really big move. But as I've said, if airlines don't start hiring now or within the next month to prepare for the summer season, you're going to have a whole bunch of fucking airplanes sitting in the desert and they don't fly by themselves. So be very cautious of this. Oh, airlines, look, they're going up. Ooh, yeah, let's go buy them. No. You need airline pilots to be interviewed. They got to move, in some cases, to other nations. And they have to get their visas, go through the whole entire fucking process, which is a pain in the balls. You got to get trained, ground training, then you got to go to simulator training, then you have to go to flight training, and it takes about 2 to 3 months to get through the whole entire process. So that would take us, let's say they start to interview in March. And then you're going to say, okay, you're going to be in class by April and in training by end of training by May, end of May, maybe June. Okay. Now, the existing pilots, they're not flying that much. I talked to a friend of mine from JetBlue. He's flying 20 hours a month. So because they never furloughed anybody, by the way. So there's room for those airlines to start to pick up the slack fairly quickly. The other airlines that furloughed, that let go of the pilots, those are the airlines that are going to have to start to hire now. Okay, so um, if there's going to be an economic recovery, airlines need to participate. You need to see those airplanes coming out of the desert. You need to see pilot hiring. And the next problem that you have is simulator, right? There's only so many simulators in the world. There's an estimate that 50% of all pilots are sitting on the ground. How are you going to get 50 or even 25% of those pilots trained in time for the summer? If you start panic hiring and you're trying to force all these pilots through, it's going to be a bottleneck through the simulators. It's going to be a bottleneck because you got to take um, pilots that are already flying, take them to training, make them instructors, make them examiners, right? So what happens? You're reducing the amount of pilots that can fly. So initially, that's another bottleneck. Once the pilots start to get pumped out, then it'll offset, but still, that's another bottleneck. It's not as simple as people make it out to be. So when I see people chasing airlines, forward-looking indicator, blah, 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 yeah, we're going back to normal. I've never known any economy go back to normal without airlines, honestly. You can't have 50% of the pilots sitting on the ground, 50% of the airplanes sitting on the ground, and saying we're going to have a good economy. That's just garbage. That's like saying, oh, look, government debt is our savings. Yeah, really? MMT said that. Where's all our fucking savings? Right? We spent trillions of dollars. Where's our savings? So, I don't know. At least that's how I'm looking at it. Anyway, let's continue. Uh, Hilton, this is my little indicator. It's doing good. It's almost back to the previous high. All right. This is what I mean. There's a lot of front running here. You have Hilton, you have Diana Shipping, which is cargo. You have Avis, Delta Airlines, Royal Caribbean. Why are the stocks so high when the leisure industry is not really kicking into gear? Now, in Diana Shipping's case, okay, commodities are rising, so the shipping cost should rise. Same thing with Tsakos Energy, although it hasn't done a whole lot of moving up. So why are we near all-time highs? Right? Excessive deficits going into the savings bubble. People chasing fucking stocks they know nothing about. That's what's going on. China, right? Big breakout from failed move, comes fast, moves back in the opposite direction. It looked like it was going to the moon and then boom, straight fucking shot down. So now you can expect this one to likely break the previous low. Uh, Same thing with CQQQ, right? Coming right back down. That's what we expected. I sold out of this one near the top, so that was a good call. Let's see how this continues. Nifty 50, right at support. Look for that to break. Japan, nice little breakout. Everybody was happy. Front headline news, whatever. And now it's starting to fall right. Oops. And now it's starting to fall right back down. Okay. Let's see how. Let's see how far it pulls back. Taiwan, okay, looking fine. Cosby, uh, bull flag, I wouldn't call it, but it's a little bit funky looking. Saudi is still doing really good, especially with oil prices up at 63. We'll talk about oil here in a minute. Australia is pulling back a little bit. Brazil, okay, emerging markets. Remember what I said, right? Higher interest rates bad. So, sure enough, we're seeing a pullback in Brazil. So keep that in mind. Now, overall, emerging markets are still in an uptrend so long as it remains above this trend line. Okay, um, so it's starting to break down now. Keep that in mind. Uh, low interest rates are great, uh, and the weak dollar is great for emerging markets. But when interest rate starts to rise, investment money leaves those nations. They run into the U.S. Their interest rates start to rise. They have very high debt levels. They need to maintain dollars, and then when those dollars of investment are pulled from the emerging markets, well, that leaves them high and dry. If you want to know more about it, look at the currency crisis back in 19, I forgot what it was exactly, 98, I think. The Asian currency crisis. Um, look that up and you'll see what I mean. So again, it's not necessarily the interest rate that is the problem on the 10-year. The problem is the speed at which it is rising. Now, you want to say that, QE is probably what's going to happen, okay, right? That the Fed is going to step in and start buying the 10-year to push the interest rates down. Uh, but from what I understand, that's not what the market is looking for. They don't want another stimulus. They don't want no Green New Deals, and they want higher interest rates. Remember, MMT says, well, the Fed sets the rates. Really? So why are the rates rising? Right? And now the Fed is going to be forced to raise interest rates to do something. I don't know exactly what they're going to do. They'll come up with some fancy title, but at some point, you got to deal with these rising interest rates, right? Because it wreaks havoc not only domestically, not only for CFOs and zombie companies, but for the whole entire planet when they raise, when the interest rates rise rapidly. It's the speed at which something changes. It's the same thing with inflation. You can have inflation. It's just the speed of what inflation comes in that is problematic. Okay. Last thing you need is higher borrowing costs when you have high unemployment and a fucked up economy. Last thing you need is rates to start to rise. Now, if rates were to remain high and not be QE'd, okay, what would have happened? Well, not a whole hell of a lot. You see, again, when when you suppress interest rates, you get a benefit from it, but it's a short-term benefit. It's not long-term. And the speed at which something comes down matters. So, in the great financial crisis of 2008, when you had QE keeping interest rates low, suppressing those interest rates, so people can refinance their homes, let people get back into the groove, that's okay. I get it. But if you continue that and you don't unwind it and you don't let the market price discovery go out there and be absorbed slowly over the course of 11 years, right? Because uh, you can do the QE for the first, whatever it was, 3, 4, 5 years, whatever, and then the other 5, 6, you can start to ease up and let the market come back to normal, right? But that's not what they wanted. They wanted to keep pumping up the stock market. All right, well, you pumped up the stock market and you gave tax cuts, repos that are not QE, remember that? Um, Deficits were increasing. When? During the good times. And now during the bad times, they just do more of the same. And now that interest rates are rising, well, now they're pissed off. Now they're like, well, this sucks. Yeah, but that's what I was complaining about during the good times. If you're going to give tax cuts, increase deficits, and repos and all this bullshit, if you're going to do it now, what the fuck are you going to do when there's a recession? And I'm not talking about a depression like it is now. I'm talking about just a normal recession, not this fucking disaster. So they come in hot and heavy, and they say, well, monetary and fiscal policy work best when you do it up front in large quantities, and that's going to get us back to reality. No, no, because you're in a pandemic. You don't understand what the problem is. You're not going to get the economic growth that you think you are. It's not going to happen. So what did they do? They blew their fucking load. Now they can't continue that. Interest rates are rising. And again, I don't think we're going to have high interest rates. But interest rates are rising. And now they're sitting there twirling their thumb trying to figure out what to fucking do next. They're like deer in headlights. See, it always appears as if the printing is what causes the economy to recover. No. Economy recovers when economy recovers. Does it help to print? Yes, it does. It helps, but it doesn't fix it. It's not the reason why an economy starts to recover. It recovers on its own. Well, when you don't allow the economy to recover on its own, right, what ends up happening is you're making things worse, not better. Because you're not going to get any economic growth in the middle of a fucking pandemic. It's not going to happen. Borders are closed. The four major economies in the world were fucking shut down. And okay, I'm going to print all this money and then we're going to get economic growth. It's not how the way it works. This is what I'm saying. These are incubator economists. See, it works really nice on a piece of paper inside of an incubator, and X equals Y, and then the supply curve and demand and all this bullshit. It works great, but it doesn't work in reality. And they blew their load. Now they're getting these interest rate spikes, and they don't know what the fuck to do. Okay, and if you take away that punch bowl, oh fuck, this market is gonna fucking tank, and that's why I've been saying we're running towards a cliff at top speed in the dark, and now it seems to be finding a little bit of a cliff, and this is what it looks like, right? This is exactly what it looks like. So how hot and heavy is it gonna get? I don't know, but I'm gonna find out. Emerging markets continuing to come down. I'm sorry, BRICS, Brazil, Russia, India, China. That's starting to break down. Real estate, okay. I'm not going to talk too much about real estate, but again, there's less and less and less and less supply, more and more and more higher prices, more people that want to buy, and they think they're getting a bargain because interest rates are low, and now, it looks great on the way down um, when interest rates are coming down, but when interest rates start to rise, it's not going to be that much fun. For now, we have very low supply. And why do we have low supply? Because nobody feels comfortable to leave their home and sell it and go buy another one. They don't know if they're going to have a job. Okay, so that's exactly what I said was going to happen. That's exactly what is happening. And the people that are buying now, thinking they're getting a deal, they're not. They're paying all-time highs nominally um, for these homes. They're not getting a deal. And now interest rates are starting to rise. Well, think what's going to happen when supply of homes starts coming into the market. What's going to happen? Disaster, right? It's going to reverse. So again, this higher interest rate thing, problematic, and you don't know what the fuck is going to blow up. Seriously. Banks, new highs. Okay, going all the way back. There it is. Okay, so they broke out through the double top. Now, why are they breaking out? Well, when you have the 2 year and the 10 year, 2 year or less, near zero, and then you have the 10 year rising, well, that's the risk parameter, right? That's where all the profit is. So the more profit they have, and I'll show you this here in a minute, more profit you have, the more risk you'll take, okay? Because you can absorb hits. So that's why the the banks are moving higher. Now, it's not because of higher interest rates. It's because of the spread between the 2 and the 10 is high. Okay, it's not because of higher interest rates. Banking, double topped here. Okay, not all-time highs, but you had a head and shoulders, broke down. This is a more pure banking ETF, the KBE. Okay, it's not like XLF. So that's pulling back now. All right, let's talk about oil. All right, oil. Let me take this out. All right, so you have commodities up against resistance. We're going to see that here in a minute. So that's starting to pull back. Um, I think the whole entire commodity thing is going to have a pause, if not a pullback here. And for that reason, I think interest rates are going to start to reverse and start to fall. Okay, I'll show you this in a minute. But keep an eye on oil. I know a lot of people are like, oh my God, it's going to, $100, hyperinflation, whatever. No, one step at a time. It's not that easy. Demand is what drives mainly oil. Demand, okay? Now, yes, we're getting a weaker dollar, and the dollar does affect oil prices, but it's a combination, okay? If the market thinks inflation is coming, then uh, they want to buy all commodities. And remember, commodities are very small. It's a small market, so you get a little bit of money flows into it. You're gonna you're gonna pop those prices up very quickly. And that's why I've been bitching about agriculture. I said, watch, agriculture breaks out here, you're gonna have people starting to bitch about the price of food in the supermarket and hyperinflation, blah blah blah, just like we experienced back in 2009. Peter Schiff was right, blah blah blah. But it has to do more with money flows. Okay, money flowing out of stocks, bonds, or excessive amount of dollars that eventually find their way into the small market of commodities. Then commodities start to rise. Then people start crying about inflation. Then the 10-year starts to pop. So you see the sequence of events, right? It's exactly what's happening. That's why I've been screaming about commodities for a very long time. And sure enough, it did play out. All right, gold. Okay, huge fucking tank. Double bottom here did not hold. Did not hold. It's going down towards that support area. Okay, so where's the inflation? Why would you be selling gold during inflation? Doesn't make any fucking sense, right? So what is this telling me? Well, what it's telling me is that everybody's selling everything across the board, and they just want to raise cash. That's what's going on right now. Everybody wants to raise cash. Uh, silver. Silver had a nice little bullish setup, and now it's starting to break down for the third time from this trend line. So even if I adjust it a little bit, it's still breaking down. Nice little cup and handle. Let's see if this holds. I'm not sure, but again, if we go with that theme that everybody's going to sell everything, including Bitcoin, across the board to raise cash and try to figure out what the fuck is going on next, well, that makes a lot of sense. Why gold and silver are pulling back. All right, commodities. This is what I'm talking about. Okay, this goes back to 2009, and you had this point where it popped and started to fall, and now you're right back up there. You're going to find resistance. I doubt this is going to go through this support area. If there's going to be something bullish, then you need something like this, okay, or just above it. That would be bullish. A straight shot through it, unless there's something extraordinary that's going to happen. I don't think that's it's going to push higher. So what happens? Well, if the commodities stop going up, then some of these inflation fears will cease. If the inflation fears cease, they're going to start buying bonds again. And if they buy bonds, they're going to lower interest rates. Okay, so that big spike that you saw in the 10-year, I don't know if I showed it to you. Oh, where is it? That's the dollar, right? So look at the dollar. Dollar's kind of high basing against this falling wedge, and if it breaks, okay, it's going to go to the upside. Well, what does that do to commodities? Right? It makes them cheaper. So what happens to commodity prices? Commodity prices will start to fall. Now look at the 10-year. Okay, 10-year broke back below these two resistance area in here. Okay, it looks like it's in the middle of nowhere, but you can use the compass of commodities to say, you know what, commodities will stop going higher. So that's probably going to reverse interest rates. Interest rates will start to fall, and then the dollar will start to strengthen. Okay, and things will kind of normalize a little bit. Okay, so just kind of keep that in mind. Let's look at the ETF DBC. All right, it's made a really nice big move from the bottom. Let's measure that real quick. Okay, it's up 65% from the low in May. All right, and again, this was a lower low, and then it bounced and then broke the longer term channel. Okay, now if and when it does start to pull back, look for more upside. Look for more upside, because This stimulus is going to pass whether you like it or not. Okay. Precious metals pulling back. Base metals. Okay. Look at that. Came really close to the previous high and then started to pull back. Okay. So again, you're finding that resistance. You're finding that resistance. Steel. Same thing. Double topping. That's it. That's why I think interest rates don't go much higher from here. Palladium going sideways, doing nothing. Copper, big fucking move to the upside. What is it doing? Up against resistance. Bang. Like magic. Right? So again, you want to be buyer of the 10-year, not a seller. DBA agriculture. This is what I'm talking about. Okay. Big move from the downside. Remember, people are going to look at their supermarket bills and be like, "What the fuck's going on?" It's up 33%. Right? Again, it's the rate of change that people notice. If you do it gradually, they won't notice. Right? It's kind of like putting the frog in the pot with the warm water and then slowly increasing the fire. Right? But when you start getting that rapid move, people are going to start bitching. Sugar breaking out, long-term downtrend. It's probably not going to push much higher. Corn broke out, right? Wheat broke out. Well, it's about to break out. Soybeans to the moon. Forget about nat gas. All right. So Bitcoin again. Let's see if this holds. All right. Let's see if this holds. If not, it needs to come down a little bit more, somewhere around 42,000. Right. I shouldn't be telling you this, but I will. Ethereum. Okay, it looks a little bit better. It has a higher low. Litecoin, Ripple, skip that stuff. Dollar we talked about. US dollar, Japan. Dollar is rising against the Japanese yen. It needed to correct. It is correcting, but at some point this will probably start to reverse back down. Euro USD is building pressure above this longer term structure. Okay, so that's bullish. That's not bullish for the dollar, it's bullish for the euro. Great Britain pound. I've been saying this for a long time, that eventually we're going to start to break out of here. Okay, it's not going to happen now. It's going to come up against resistance, build pressure, and then eventually it's going to start to break out. So long term, the dollar doesn't look very good. Okay, U.S. dollar against the Turkish lira is starting to strengthen. U.S. dollar ruble nothing. USD CAD, big fucking drop and then a big pop. Right, this needs to correct at some point. It's a falling wedge, so this needs to correct. All right, so let's put this here. But there'll be some kind of a correction, and then it'll resume its down move. All right. Australian dollar looking fine. New Zealand dollar looking fine. The dollar against the Mexican peso is rising, and dollar yuan is going sideways. All right. So the euro index just kind of building pressure above the structure, so that's bullish. 10-year we talked about. Aggregate. Now here's the deal with the aggregate bonds. Look at that. Look at that drop. That is a big fucking drop, and this is what I call a limp tick. Right? It kind of looks like a limp tick. Right? It kind of does this. Right? It's a limp tick. Usually these things pop, and they pop hard. So I didn't expect to move yesterday, to be honest with you. The only other time that it really kind of started to drop like this was back in 2013. We had the same kind of deal in 2016, and of course we had a one with COVID, right? So you get these kind of crazy moves down. Again, I'm not in the inflation camp. Let's see, at some point here it's going to start to bounce. So again, you want to be buyer of bonds, not seller. Skip that. Investment grade bonds, same kind of deal. You can see the big drop. This should have continued on up here. It didn't, and that's bad. And that's bad because you have an M pattern here now, right? You don't want fucking M patterns at tops. That shit should make you nervous. Junk bonds. Government is buying it. They're like, yes, we're okay, my friend. Everything is fine. No problem. Okay. So they barely fucking moved. All right. Here's the other resistance area. Now remember, when you have TIPS, Treasury Inflation Protection, and people are running out and buying more of those than they are of the 10-20 year, then that's signifying that there's fear of inflation. Okay? And I was really surprised that it broke out here. I was surprised. Um, but it came up right up against resistance and pulled back. Remember the other indicator that we were looking at? The commodities? What the fuck is it? Fuck, lost it. Plus, I'm dyslexic, so when I'm looking for something, I can't find it. Fuck me. Where is it? Look at this shit. You believe it? I can't find it. There it is. Look at that. See? Boom. Same thing as tips. So tip versus 10 year and the commodity index, they're both up against that resistance area. So please keep that in mind. I'm telling you, interest rates are going to start to reverse here. More likely than not. More likely than not. TLT, big fucking drop. All right, limp tick. You break the top, you break the bottom, possibly, but not in a straight shot. This is the 10-year yield. This is the interest rate yield. And then this is TIP, Treasury Inflation Protection. That's even been sold, and it's even broken down from here. But again, it's the ratio that you're looking at, right? They sold more of the 10-year than they did of the TIP. Banking in Europe, okay? Nothing to talk about. Royal Caribbean, big fucking moves like airlines, okay? Norwegian, big breakout, pullback. Carnival, breakout, pullback. So now let's take a look at the fangs. All right, here's the fangs. Right, a key area. It cannot break here. If it does, the whole structure is broken, and then we could start looking for further downside. Okay, so that's not looking good. Amazon broke down, not looking good. Double top, by the way, back here, M pattern. Microsoft broke out, failed, right back below the previous high. Facebook continues to push down. Netflix, no breakthrough, just hanging out there. Google broke the rising F flag, pulling back. You had Nvidia broke out, no follow through. Tesla broke down. Okay. PayPal reversal. Snapchat is holding on. Shake Shack pulling back. Now let's take a look at the airlines. It's that crazy move up, which is way the fuck overvalued. American Airlines, same thing. Southwest, Alaska pullback. Now Alaska has its own little niche market. Okay, so that's a better kind of stock if if you're adamant about fucking speculating. JetBlue up against resistance, pull back. Spirit pull back. Allegiant, bullshit fucking move. Sorry, broke the previous high. No. It's a perfect chart that shows you just how fucking overvalued shit is. Hawaiian Airlines, pullback. SkyWest, breakout, pullback. Ryanair, EasyJet, okay. Copa, and China Eastern Airlines. Turkish Airlines. Turkish is doing a little bit better than everybody else, okay. But still, crap. And that's about it, all right. That's about it. So what's going on with NASDAQ? Let's take a look. Right. So had a little pop this morning, pulled right back down. Perhaps we're doing some kind of a V bottom here. Right. Perhaps, maybe. Um, there's so many wicks back here that you don't know which one it's going to hold. You don't know which one is going to hold. Is it going to be this one? Is it going to be this one? Who the fuck knows? But it seems like it's trying to bottom here a little bit. Now, again, if you are a bear, what you want to see is this to start to recover and then start to fail. And it will take a couple months for this to happen. Okay? At least a month. Because remember, the market has to be ready to go down. I think one of the main reasons that the market, fuck you, that the market, bounced so hard uh, during COVID was because it was such a shock. The market was not ready to go down that nobody was willing to sell. And when that happens, no one is willing to sell. Well, you're only left with buyers. So then you get this artificial um, artificial kind of buying going on because everybody's like so fucked that if they can hold the positions, they will. Yeah, you know what I mean? So nobody was expecting it. If this time around it starts to tank, it's going to be ready. And how do we know that it's going to be ready? Well, everybody and their mom is a stock expert now. Every fucking advertisement. It's just like gold back in the day in 2008. Buy gold, buy silver, hyperinflation crash, JP Morgan, I love gold, blah, blah, blah. It's real money. It's the same shit, right? What happened to gold? It collapsed 50%. The same thing that's going on now in the stock market. They're trying to pump everybody and their mom to go into the stock market because remember, these big guys, they got to sell it to somebody. They got to find some fools to sell it to. So you get the GameStops, the AMC, the cannabis, and everything is going up, and everybody's like, "Oh my God, let's buy GameStop and beat the man, and the man is gonna beat your ass." Speaking of GameStop, okay, everybody got all excited about this. Some troll who's like, "Look, GameStop is going up." It's like, you fucking idiot. You don't learn. You don't learn. This is just a bigger M pattern. That's all it is. You want to short the shit out of this one. This is crap. Go to a GameStop store and walk inside. It's empty. It's not. It's not. It's so obvious. You don't even have to fucking think about it. You know. I don't know. Whatever. Uh, yeah. So again, a lot of experts out there. Everybody and their mom is a stock expert, and there will come a day where everybody and their mom is going to hate stocks. I know it sounds impossible and crazy, and it'll never happen. That day is coming, believe me, and it's a lot sooner than people think. Okay, it's a lot sooner than people think. They will hate fucking stocks. Buy the dippers are gonna get crushed. They're gonna be like the Bitcoiners that went out and bought Bentleys, and now are flat broke. So keep that in mind. Keep that in mind. Right. So VIX is kind of holding right above the trend line here. Last time it kind of high based, it collapsed. Okay. So how do we know if it's going to collapse or not? Well, easy. Look at the 10-year. Keep an eye on the 10-year. Keep an eye on the small caps. Okay. For right now, it looks like it wants to go higher. All right. Look at that. Where is it? Look at that. Go straight up. Pull back. Starting to go back up. Now, is it going to double top and start to reverse? Right. We'll see. We'll see. But as long as the 10-year keeps rising, market is going to go down. When the 10-year stops rising, then everything is going to kind of stabilize. Doesn't mean it's going to go back to what it was before. Um, it just means that, there's going to be some kind of stability in stocks. That's it. So, again, this move down is very sharp. Needs to correct to the upside. So, limp-tickish, right? Limp-tickish. Any questions? Anybody? I don't want to start bitching about fucking MMT. If you guys don't ask questions, I'm going to start bitching. Don't make me bitch about JetBlue. Not JetBlue. What the fuck? I was looking at the JetBlue news. Yeah, don't make me bitch about fucking MMT. We can print to inflation. Yeah? So now what? Forget about the fact that I don't think we're going to have inflation, but the market believes, and everybody's thinking, screaming inflation. So now what? What do we do now? Austerity? You see? MMT doesn't understand inflation. It's a great way to end and tie the knot on some fictitious fucking story that they sell to people. It's great. Yeah, well, we can print to inflation. Oh, okay. All right. La, 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 la. Yeah, okay. And then what are you going to do? All those free uh, candies that you handed out with the job guarantee and free homes and free this and free that and tuition and all that stuff. What are you going to do then? Now what? You're going to start laying off people on the job guarantee because deficits are too high? You're going to make people pay their uh, student loans now? You're going to kick people out of the house? What are you going to do? Take everything back? You can't. This is why when they say, well, we can print inflation, it's garbage. It just sounds good. It's not reality. They can't do that. If they were to get more of their way than they're already getting, they can't do it. It's just a political ideology that's trying to make people feel comfortable with government printing trillions of dollars, giving it to the top 5%, and making you feel smart in the process on social media. That's what it's all about. It's got nothing to do with real economics. Nothing. All right, so February 25th, we had another million. We've been getting a lot more million um, hits, which is good. Which is good. So we're about 50% from 2019. All right, and if you go back to 2020, we were still at 2.3 million plus, 2 million plus daily travelers. So we're 50% below that, but the economy is going to recover. Uh, they're linking 10-year with reserve balances. Yeah, but that's another one. Reserve balances. I think I have it here. Okay. Now, this is discontinued, but it doesn't matter. I can show you the other one. Reserve balances are up to 3.2 trillion at the top, right? How much is the QE? 7.5 trillion. So where the fuck is the other 4 trillion? 4.3 trillion. You see? It doesn't make any fucking sense. And that's the part that makes me crazy. Because they're trying to say, well, it's just an asset swaps. They're just swapping a bond for a reserve. That's what QE is. Stupid. Okay, so where the fuck is the other 4.3 trillion? They gotta have an answer. You don't just fucking, it just doesn't disappear into fucking thin air, right? So where is it? Well, it's in the stock market. That's where it's at. It's in asset prices. Remember, when a bank lends to another bank, the reserve remain the same. You're not going to be able to see it. There's no drainage when a bank lends to another bank. The only time you see a drainage is when that money is converted into something other than a reserve, right? And the only way you can drain reserves is if you pull cash out of the banking system. Banks buying bonds and selling risky stocks to meet requirements. No, there's no requirements anymore. That's why this, see this? It says reserve balances required, discontinued. Why is it discontinued? Because there's no more reserve balances. That ended back, you can even see it here. It ended on April 15th. Oh, I'm sorry, April 1st. Reserve requirements went out the window. So I don't know what the fuck they're talking about. Remember, the green one here is excessive reserves. That's more than what is required by the Fed. And the Fed removed the requirement. And that's why it drives me crazy when they're like, "Oh no, you don't understand." You don't fucking understand. You gotta come up with 4.3 trillion dollars, my friend. You don't got it. You don't got it. So if Bank A borrows from Bank B to go out and buy bonds, are the reserve requirements going to change? Nope, because it's still in the banking system. What if people pull out money from QE? They sell their bonds and then they pull out their cash. Is there going to be a drain on reserves? Yeah, absolutely, of course. That's the only thing that can do it. Or two things. Or the banks go out and buy bonds. Okay, that's that's uh, that's the only two ways you can drain reserves. Now remember, reserves, treasuries, dollar bills, coins, high-powered, low-powered money, deficits, they're all money. So if you think of this as money as dollars and stop using these fancy words depending on where their location is, whether it be in the banking system, not in the banking system, uh, then it will make a lot more sense to you. But clearly, there's $4.3 trillion missing. Let me see if I can find the one up to date. Right. So here's the other one. Employment ratio, 57.5. You're gonna get fucking what? Inflation with 57.5% of the population working. These are numbers we had back in the 50s. You're not gonna get that kind of consumption that's gonna drive up interest rates. Sorry. There it is. Total reserves at the Fed, uh, 3.153 depository institutions, which is what we were just looking at. Okay, excessive reserves. Only it's not green, and there's no reserve requirement, so there's no purple down here. Right. So where the fuck is the other 7 point? I'm sorry, 4.3 trillion. I don't know. I don't know. You tell me. We're just an asset swap. So we have 7 trillion of Fed holdings, and then depository institutions, banks, have only 3.153. So where's the other 4? I'll keep saying it. Look at this one. Ages 25 to 54. Government expenditures falling. Your prime age labor force is out of the workforce. How is that good? How is that inflationary? What about corporate profits? Ooh, all-time highs, 2.1 trillion. Yay. Where'd that money come from? Who's making money? Who is making so much sales and profits for corporate profits after tax to be at all-time highs? Government debt equals private sector assets? Yeah, to who? Corporations. That's to who. Not to you. You're just being fooled by MMT. All right, prime age labor force, 76.4. We haven't seen these numbers since the 1984. That's a great economy. Inflation. M2 is going to be discontinued. We're going to do it monthly or some shit like that now. Look at M2. Exploded. Well, we don't want we don't want you to see that. Yeah, we'll just discontinue that. Yeah, we'll do it monthly. Lagging indicator. Fuck me. MMT baby. MMT in action. State and local governments, debt security loans, liabilities, and so forth. Not at all-time highs yet, but it's sharply moving up. Total debt to GDP, right, all-time highs in Q2 2020. Now it's starting to pull back. You think that's going to continue? I don't. All right, so here's the. Is this the one? No, that's not the one. Let's get this one. This is outdated. All right. 7.557 trillion dollars in the back Fed's balance sheet. Where's the other 4.3? Where's it at? Magic. It's just an asset swap. Mm-hmm. Sure is. All right, so it's Friday, 10:55. We had the 10:30 reversal. Uh, Point of control. All the way the fuck up here. Okay, so very far away. The pullback so far has been 9%, top to bottom. Actually, a little less, or less 9%. 9% on the money. Now, remember, when it starts going more than 5 to 7%, it's a much deeper correction. 10% pullbacks are far more rare than 5 to 7. And when you start getting to more than 5 to 7% pullbacks, you start worrying about that 20%. Okay. Now, you never know till hindsight. So, uh, the more likely scenario is a 10% pullback and then it starts to go back up. Okay, and that would make a lot of sense when you look at the resistance against commodities, the resistance against the tips versus TLT, uh, finding a reversal in the 10-year. That would make a lot of sense at 10% correction. So you would see the stock market go back up. But again, it doesn't mean that it will continue to keep going back up because you'll see probably interest rates start to rise until the market gets what it wants from the Fed. And the Fed, we know, will do anything that the market wants. So just keep that in mind. Keep that in mind. Small caps doing nothing. IPO doing nothing. ARC doing nothing. The FANGs, nothing. So it's going to be probably a boring day today. It's not going to be as fun as it was yesterday. All right, let's take a look at the 10-year. Back up to 150. Now remember, this is incredibly bullish. So it could high base here for a couple days, maybe a week or two. All right, we'll see. We shall see. Let me see if there's anything else in here that is of interest before I go. Unless you have any more questions. I really don't want to bitch about JetBlue. I mean, about MMT. Fuck. I said it last time, that's why I'm saying it again. Alright, so costs, right, coming right back down. So much for that AMC pop. Oh, we're going to be rich. Right back down. How many people got burned on this one again? Right? How many people are like, oh man, the guys were always right. I just needed to hold. Let me buy now. And then bam, it blows up in their fucking face. You know, I wish I could help those people. I do. I really do. This is value S&P versus S&P. And as you can see, the value S&P has been outperforming since September, August, September, somewhere in there. Okay. This is a bear flag, so it doesn't mean it has to break out to the upside, but it has been out. Value has been outperforming the S&P 500. Okay. There was something else I wanted to show you. All right, Tesla versus Nasdaq is about to break down as well. Okay, it already popped back up. So keep this one on your radar. Okay, Tesla is going to come down much faster than NDX when everything starts to take a shit. And if it breaks this structure, more likely than not, we're going to be in the shit. Okay. So small caps, Tesla, these are all risk on plays. And when it's risk off, these fuckers are going to start to come off. Along with Bitcoin too. It's risk on. Copper is going to start to come off. Okay, copper up against resistance. Against gold. Okay, so this is copper gold. Copper is outperforming. Breaking out. But look for this to start to reverse as well. What else? Alright. Commodities, real estate, tips, emerging markets, and financials broken out. This is another one of my little indicators here. Look at that. Huge fucking breakout. Huge breakout. Look at space, huh? Everybody's so excited about space. Boom. Boom. Bye-bye. Yeah, if you're making rockets that crash on landing, usually doesn't work out very good. XOP, I've seen a number of guys talk about, as oil goes up, you should buy XOP or Occidental Petroleum. Don't do that. If you want to buy oil, buy oil. You want to short oil, short oil. Don't use these as proxies. It's kind of like using the gold miners to buy gold. That's a stupid trade. Don't do that. Now, if you like the company, different story, but don't do this proxy crazy shit, please. Por favor. Yeah, you've seen food and increase. Yeah, of course. Also, some scarcity in supply supporting unemployment continues. Yeah, well, it's not a factor of demand. That's the problem. The inflation that they're talking about has nothing to do with consumption. It has to do with monetarily. It's a monetary phenomenon, and they're using some kind of old school, money. Inflation is always and everywhere a monetary phenomenon. Yeah, that sounded good back in the 70s when Milton was talking about it, but it doesn't apply to today. It doesn't. Not even close. And I'll tell you why. One, we are net importers. We export dollars to the rest of the world. That's deflationary. We are about 800 billion a year. So when you look at the deficit, for example, and you'll see the deficit is, I don't know, 3 trillion. Well, almost a trillion of that is exported to the rest of the world. Okay. Um, Social Security is not really part of the deficit, right? It's what you paid into it, so you're getting it out, but it shows up as deficit. Um, so don't look at it from the Milton perspective, and that again, that's why I think these incubator economists got it wrong about inflation. Okay, now that you're creating commodity inflation because of money flows and the dollar's weak, yeah, you're going to see inflation in food and energy for sure, for sure. And you want to print more trillions and have a Green New Deal and all that other stuff, you know, well, that's problematic. But it's not because the M2 money supply has skyrocketed. No, that's helicopter money. It goes away in 6 months. Stop giving pandemic unemployment insurance, you're going to see that savings rate go whoop, right back down. What it has to do